I come to you today with some potentially good news. The Consumer Price Index report was just released, and if you're not familiar with what the CPI report is, this is a report that's released that lets us know how much consumers are paying for goods, okay? So as you hear in the headlines that inflation is setting in and making the price of goods a lot more expensive, well, this is exactly how we gauge how much more expensive the goods are. So it's very important to pay attention to this report. But this report is also a leading indicator on how interest rates may fluctuate as we move forward. So I'm going to explain a few things to you regarding this most recent CPI report, and hopefully your takeaways are the same as mine, and that is, well, just wait to find out. Okay, so to make things easy, basically inflation is tied to mortgage rates, right? Basically, the higher the inflation numbers, generally we'll see higher interest rates. Okay, so if inflation comes down, mortgage rates should also follow suit, and then vice versa. If inflation goes up, theoretically, we can expect to see mortgage rates go up. But here's the caveat. This year, economists were actually off, which doesn't surprise me, but the report actually came in lower than expected. Now, the core CPI, which does not include food and fuel, actually came in at an increase of 0.2%. Now, economists actually slated the increase to be about 0.3%. So as I mentioned, it is less, and although it's marginal, at the end of the day, less is less. And while we're talking about the federal government and economists, well, the Federal Reserve, although they said that they may raise interest rates again, it's not expected anytime soon. So how does that impact the mortgage industry? Although we read headlines about mortgage rates increasing, which is true, at the end of the day, mortgage rates are still historically low. And when we factor in this inflation, which does appear to be easing and also not as high as expected, well, consumers are really starting to feel comfortable again. And with that being said, the motivation from the buyers, well, it's still there, even though the interest rates have gone up. Again, historically low rates. And when we factor in the CPI report and the fact that the feds will probably not raise rates for quite some time, really puts buyers in the current market in a pretty decent position. At some point, and again, none of us have a crystal ball, but at some point, the additional hike in interest rates will start to slow the housing market. There's got to be a breaking point, and we don't know what that breaking point is. My expectation is probably somewhere in between the high 8 and low 9% interest rates. I think that's when we will really see buyers take the sideline and no longer have this desire to transact like we're seeing right now in today's market. So as I mentioned in the beginning, friends, all of this is good news. And again, I wanted to present it to you because this report just came out and it really shows or paints a picture as to what we might expect over the next few months. And well, we're in spring, and we know that the spring and summer markets tend to be the busiest. So hopefully you also found this information to be positive. If you find this content valuable, well then hit that red button and subscribe and mash that bell so that you're notified when I post content like this. And with all of that said, happy Mother's Day to all the mothers out there. Take care.